The broadcast is now starting. All attendees are in listen-only mode.
Well, good evening, ladies and gentlemen, or good morning if you're in the Southern Hemisphere. Welcome to this Danielcode webinar. It's, as usual, a beautiful day down here at the Gold Coast on Queensland, Australia. Today's a important day for us in this part of the world. It's Anzac Day, which is a mnemonic for Australian New Zealand Army Corps, and it's our military day. It's the day in which we recognise all those who've served in the wars on behalf of Australia and New Zealand. One of the few things I guess Kiwis and Aussies agree about, and a special hello to you, Shift. I'm sure you were up early for the dawn service, and it was a beautiful morning. So welcome, folks. Thank you for being with us today. We've got sort of three main things to talk to you about today, all very important, I hope you'll agree. We're going to talk at some length about FractZen, its performance and the stop-loss protocols. We have identified some errors in Forex results for March. No change in futures to the results we've been showing you, but we have identified some errors in the way the stop losses were identified in Forex in March only. And our special guest today, Daryl Mustang Narain, is going to talk to you and show you some spreadsheets and go into that at considerable length. He is concerned here today only with the Forex stops. There's no change to the results we've been showing you in futures, and we'll be able to update you for the end of March and the first fortnight in April as well. Then we're going to talk a bit about the long-term forecast. I'm going to tell you where I think the market's going to be in the next few months and towards the end of the year, and I'm going to show you the exact conditions that would we could interpret as a failure in that progress. So you not only need to know where the market's going, but you need to know when the forecast will stop being valid, and I'm going to take you through that. I also want to show you some trading into this recent pullback and rally in the equities, and we'll be using the S&P to show you that. And I'm going to talk about a couple of the more difficult concepts of trading, like when to hold a trade and when to take your profits. So to start with, the first half an hour today is going to be dedicated to updating the results with FractZen. Daryl and his wife Sage have been keeping the results for us for FractZen, as you know, since the beginning of the year. And we have 20 markets that we're currently covering in FractZen, 11 futures markets and 9 Forex markets. And between them, they've generated something in excess of 700 signals since the beginning of the year. So the work they've been doing, because we haven't had an auto trade running, they have had to do it all manually, and it's been an incredibly demanding and very, very difficult job. And we're most grateful to them for the work and effort they've put in. So I particularly want to thank them. Some of you know Daryl and Sage from tutorials. Daryl's an old friend of mine. He's probably one of the, together with Sage, they're very early adopters of the Danielcode. They've done a number of, probably a big number of tutorials. And I've known Daryl, been working with him I suppose, for well before Danielcode even went online. So he predates the website and all the stuff that we do. Daryl's a very esteemed New Zealand corporate man. He's a member of the Institute of Directors. He's a director of a number of substantial companies, very experienced businessman. He's also a member of the Institute of Chartered Accountants of New Zealand, which is a pretty senior, very senior accounting qualification, and he's also a demon car driver. He's a famous racing car driver, and these days he still races. He's got a beautifully restored and very, very hot, I think it's a 65 Mustang, which is why his forum name is Mustang. He rides a Harley Davidson as well in his spare time. He's a pretty wild guy, and these days he's also very involved as a leading rally driver, and he's actually the works driver for I think you tell me you're driving an HT8, Daryl. Anyway, you can fill the folks in on that. So folks, I'm required to, as usual, show you the compliance conditions that you all over our website, and we're required to keep reminding you that there is risk in trading, and that hypothetical results have some limitations. Although I must say the way we score FractZen, it's not really the way most hypothetical results are done. Most hypothetical results are done with the benefit of hindsight, and the trades are always, you have the benefit of seeing what came next on the chart, which is its greatest limitation. Daryl and Sage don't do it that way. They take the FractZen signals exactly the same way you get them, and they record them and they measure them not far off real time. So it's considerably better than that. But we do have to remind you about the risks in trading, and let you be aware that you should always consult your broker before taking any advice that you may get here at the website. So Daryl, welcome. You should be able to hear me now, Daryl. Good morning. How are you?
Hi, John. I can hear you well. Can you hear me?
Yes, we're good. You're coming in loud and clear. So I'm now going to hand over to you. You've got a large number of spreadsheets. I know you've been working for days and days on restating the March Forex results, and you've been on a deep dive into the stop-loss protocols and how they would affect the various results that we're showing. So I'm now going to make you the presenter, Daryl, which means that you will have the microphone and control of the screen. So we'll now, I'll now make you the presenter, Daryl. Hit me on Skype if you don't get all of this.
Okay, here we go.
You should be on now.
Show my screen. Can you see my screen, John?
Yes, I can.
Oh, good. First of all, good morning to everybody. I'm sure there's quite a few people on the webinar this morning that I do know from past tutorials and some of the antics that we've got up to. Danielcode, people always have very fond memories for both Glennis and myself. John, thank you for that very glowing introduction, and I think you're very generous in your comments.
Not at all.
We've just switched sponsors. Actually, we were with Chrysler, and we've just done a deal with the Porsche dealership here in New Zealand. So for the next event coming up in a couple of weeks, we've got the new Porsche Cayman RSR, which we're going to have for all of our events this year. So looking forward to getting behind the wheel of that.
Very hot, very hot. Just Daryl, to interrupt you, Hank wants to know if I attended the dawn service. Of course. The Anzac G-Mage, that'll be my good friend Shift. I'm sorry we're not together today, mate. Thank you. These people and Johnny Miranda are sending me birthday wishes, Daryl, so I wanted to acknowledge their kindness in remembering me. Can everybody see Daryl's screen now? Could somebody just type in the question box that you can see Daryl's screen? All right, this is pretty important stuff. Okay, Anzac G-Mage, mate. Yeah, they can see it, and Mark. Okay, Daryl, you've got it. People can see your screen. So over to you, mate.
Yeah, I reminded John it was his birthday this morning, so if anybody didn't catch that, it's John's birthday today. Mm-hmm. Okay, I'm going to start with the bad news and then move on to all of the good news. The bad news is that we had some errors in March, as John has alluded to, and we'd reported under our March Forex results a profit of a little over $5,000. whereas you can see on this box at the bottom of my screen here where it says text stocks total profit, and you'll see a March result there of minus $6,448. Now that is the corrected result and the true result for March. So we had a turnaround from our $5,000 profit to a $6,000 loss. Now how did it happen? Essentially with FractZen, when we get a reversal signal or a reversal text, it's really unusual that that is not triggered by its momentum into the stop loss or beyond the stop loss. And we had this phenomenon in March where we had some trades that in fact triggered the stop losses, went all that way, but then didn't in actual fact trigger a reversal signal. They went back into profit. And the way that we were analysing the data, those trades were overlooked. And it turned out it was, when we went back and analysed the various months, it turned out it was eight trades out of, well, John and I did the calculation this morning, out of 378 trades. And given the fact, as John has said, that Sage has to keep all of this data, she has to take it all off the charts manually. She records it all in a written form, which then is which I then put into, or she puts into the spreadsheets, and then I then go through and check. And so these were the way that we record the data and the way that we look at the data. These anomalies, these very unusual trades, were missed. So since then we've gone back and done a meticulous check, and we've also changed the way that we're monitoring this manually now, where essentially Sage is running stop lines right from the 1 minute chart that the entry comes off, so that they simply can't be overlooked. And as John reminded me this morning, markets are skewed, profits come in bunches, and I think that many people that have traded in March found March to be quite a difficult trading month, and it was certainly quite a different trading month to January and February. Anyway, I produced this anomaly, and we've discovered it, and we've fixed it and disguised it. But what it did, it prompted us to do a significant review on how we are running our stop losses. And I'll show you the reason for that shortly. I've got here some revised tables on different scenarios. We've got a scenario where we've used the stops that come with the texts. We've applied a 100 tick stop, 180 tick stop, and the top box there, a result which comes out of actually not running a stop. And when I say not running a stop, essentially you don't run with no stop in the market. It would be a catastrophe stop, but it's moved so far out of the way that it's not going to be hit. So it's in the vicinity of probably 300 ticks, which is, in terms of risk management, is too big for the vast majority of people. And then in April, down the bottom here, we've run a number of scenarios, the same that we did in recalculating January, February, March. Now what I've done is I've summarised all of that, so hopefully you can see my next screen. And we've taken here January, February, March, April across the 4 scenarios of working with the stop that's coming with your texts, implementing a 100 tick stop across every trade and every forex market, and then a 180 tick stop, and then as I said before, simply what I'm calling a no stop, but it's essentially a catastrophe stop where we put that stop about 300 ticks under the market so that it wasn't in fact hit. And you'll see some interesting results here in that the reworked Forex results for year to date to the 15th of April. With the tech stock, we've got a profit of $31,431. The 100 tick stock, that moves up to $32,414. The 180 tick stock, that moves up to $35,763. And then the catastrophe stock, it falls back slightly to $34,704. Now, the FractZen program, John always, well, when I say the program was designed, John designed the program essentially to reverse its positions in a pure form. In other words, that it wasn't being interfered with by stops in the market, that it simply picked up all of the reversal signals and you ran it from signal to signal. Now, John recognised that in terms of risk management, that running FractZen in that way was going to exceed the risk tolerance of the vast majority of people. So we had to set about trying to design a stop regime that we could put over FractZen, which would provide a level of risk management but wouldn't diminish the performance to too great a degree. And that has been quite a very, very challenging task, and as this little exercise has shown, I think it's an ongoing exercise. It's not something that I think you ever put in place and then just say that's it forever. I think it's something that we need to, from time to time, review. So anyway, with the stop regime in place, what this really demonstrates is that if people had a complete faith in the program and they were at the extreme end of their risk tolerance, they could place a catastrophe stop out of the way in the market, and FractZen would prove to be very profitable. For I guess the least conservative approach is to run the stops as they come through on the texts, and as you can see, that actually produces the lowest performance. In all honesty, the difference between the 100 tick stop and the text stop performance is only $1,000 difference there. In terms of the risk of running the text stop versus the 100 tick stop, you would probably say stick with the text stop. But for people that are prepared to run a higher level of risk on the FractZen program, the analysis has certainly shown that this 180 tick stop that I've come up with has produced the best result. Now, what I'm going to do is just change to another chart here. What's on my screen now? The three columns in yellow on the left-hand side are essentially showing all the trades. This is every trade for January, February, March and half of April that has hit the stop loss as set up by the text. So down in this left-hand column, you'll see all of the stop losses: 58, 68, 68, 58, for example, with the AUD USD. And then the next column over, where the column headed rev text, which is reversal text, this is the number of ticks that each of those stopped out trades went to before it reversed. And then the third column is just showing the difference between the stop loss and where the ticks actually reversed the trade. And you can see in the majority of instances that it's within a reasonable range, and then you get down to some of these bigger ones, the USD JPY, and it seems to be the JPYs where we get the big variance, where we had a 50 tick stop loss, but the reverse ticks actually took it out to 172, We've got a couple of the Euro JPYs down here where they went out to over 100, 114, 115, and then this big one on the pound JPY that went all the way out to 288 ticks. Then we've got the three columns on the right, which have got the green shading. These are the eight key trades which essentially took us in our March result from our $5,000 profit back to our $6,000 loss. And my little stars out to the side here, they just indicate one star was just over $1,000, the 3 stars, those couple of trades were over $3,000 in profit on each trade, which was given away because of the stock being hit. And those are the trades that in fact turn the profitable result round, or the false profit, it was never a profit, into the real result of a loss. So you can see here that the biggest retracement that the trade went to before it turned around and then reverted back into profit was this pound JPY, which was 161 tick into loss before it reverted and finished up over $3,000 in profit. And the stop loss on that trade was 130 ticks. Now, all I've done is analysed this first 3.5 months data from all of our trades that have hit the stop losses and looked at their retracement levels. And I've said, right, we want to pick up as many of these profitable trades that have stopped us out but then reversed back into profit as we can. And we want to try and rein in some of these very big losses that have simply destroyed the performance, but have stopped us out at a loss. They at no stage have they got us back into profit. So it was essentially looking at the largest loss here, or the largest retracement, which was the 161 ticks. And then I just arbitrarily took a 10% margin on that. In fact, it was about 12% because I rounded it to 180 ticks. So that was the analysis that brought me back to running these different scenarios where we tried running the different level of stop across the 3.5 months and seeing what the outcome was. And the optimum, I believe, in the work that I've done, that the optimum is this 180 tick stop. And that 180 tick stop run across all markets for the 3.5 months is what has produced the best result. You will see here for you'll note I've got a couple of spreadsheets, a couple of tables down the bottom here without the background colouring. That's just for John's benefit, because some of you know John's colour-blind. The colours just confuse things for him. So those black and white versions down the bottom there are just for John's benefit. But you'll see here for April I'll just go back to this summary here. You'll see, no, that's not the one I want rather. For April, the best result has actually been the one that has run with the tech stock. So, having said all that, I guess the conclusion really that you come to is that with FractZen, there are a number of...
I think you're on the wrong sheet, Daryl. This is a future sheet you're showing at the moment. You want your Forex sheet, don't you?
Oh, I've clicked on the wrong sheet.
That's what you're talking about only applies to Forex. So you need your Forex
So
summary.
there we go. This is the one.
That'll make
Thanks,
sense
John.
now. Okay.
The text. This is what I was saying. The text stock result for this is only for 2 weeks of April though. So the other sample that in terms of that summary sample, I mean that's 3.5 months. These 4 results down the bottom of the sheet here are only for the first 2 weeks of April. That's showing the best result as being off the text stock. So I guess the conclusion, if you can draw a conclusion, is that FractZen can run off a number of different stock regimes, which are really dictated purely and simply by a person's tolerance for risk. And what it's showing is that essentially with a higher level of risk you can expect higher returns. And with the more conservative approach, you will in fact you'll experience a slightly lesser returns, but still in the big scheme of things, in terms of the performance of FractZen, the lowest performing result of FractZen is still an incredibly outstanding result. And you'll see here, the extreme example where we had this very, very difficult, choppy trading month in March, where running the tech stock produced this $6,448 loss, whereas running the 180 tick stock reverted that to a 2,110 profit. The other thing too, just to take note of, is the way that the markets, the different markets perform and don't perform at different times. And this is something that that John constantly alludes to, that don't fall into the trap of selection bias, because you just can't predict which markets in any particular month or even half a month are going to be the ones that are going to be the strong performers. So in terms of what happened in March, as I say, we misreported the result. Using the tech stocks, we converted that profit to a loss, but in hindsight, it's actually been a very, very positive exercise, because it made us go back and take a very, very close look at how we were in fact imposing the stop loss regime over FractZen, and just the potential and the limitations that different levels of stock can flow through into the performance of the program. John, I will just quickly show this futures sheet here, because people will be, I assume, will be wondering if we've done all this work on Forex, what is the same situation true of futures? And the answer really to date is that the futures markets are so varied that we're not seeing those discrepancies in futures like we are in Forex. And what I did last night and this morning was I just went back through with Sage's help, went back and looked at every futures trade just for the first half of April. It's just a massive exercise to manually go back and try and reconstruct all of this for January, February, March. John has alluded to the fact that the auto trade program is running on a trial basis on the Danielcode servers, but in conjunction with Trade Navigator at the moment, and the the errors that are coming through are, I think, almost eliminated at this point. So all of this data entry that we're currently doing manually, we're just very, very excited about the prospect of all this now actually coming direct off the system, and the opportunities for errors that occur whenever you're transposing numbers manually will be eliminated. And just, yeah, and as I said, the number of hours and hours of work involved that is going to disappear is, we won't be sorry to see that go. So anyway, these numbers that I'm showing here on the screen now, this is just the first half of April, and essentially it's showing what would happen if we ran a catastrophe stop across all of the futures markets. In other words, move the stock right out of the way. And oil enhanced, basically it degraded the performance. Same with the S&P, the DAX, soybeans made only a very, very slight improvement in gold and the Russell. And the only market that it had any significant impact on was silver. But silver didn't have such a great month compared to its past performance. But overall for the month, it actually reduced the result, would have reduced the result by $1,290 for the month. So the feeling that both John and I have at this point is that the futures markets, we're pretty comfortable with the stop regime that FractZen is currently running over the futures markets. These two tables at the bottom here are just showing the sorry, get these ones right here. This is the black and white one for John, so I'm just looking at this one here that's got note this table is 1st to the 15th of April only. So just showing the futures performance for the first couple of weeks of April. It's currently return $14,388 for the month, which midway into the month is going really, really well. And then just having a look at the charts that Sage did from last night's trading, there's some incredible results last night. And last night was a big night. And in fact, I think Terry sent John a message which got passed on this morning that the auto trade program and its testing last night actually produced a $12,000 profit for the night. So this result that I'm showing here doesn't record any of that trading. This is up to the 15th of April only. So yeah, April and futures going really, really well. And just one other thing that I was just going to highlight here, I said to John this morning that I wasn't going to put this April result into the year-to-date. I was going to hold it out and I'll include it in the year-to-date once we actually get to the end of the month. And the reason I've held it out, just adding it into the year-to-date, is I just wanted to show once again the difference in performance, the turnaround in performance of some markets. For instance, silver has been an outstanding performer year-to-date, but then look at its performance here. This loss for the first couple of weeks of April, we're sitting on a $4,875 loss in silver. And if you just run across the various markets, you can see just some of the markets that have just turned around and had such a strong performance. I mean, the S&P compared to what has really been a pretty mediocre or poor performance year to date, it's done pretty well, as has gold. And then, of course, the second exercise that we do on the futures markets, where we do this equalize margins exercise, where, as you know, for instance, to trade the DAX, you've got this huge margin requirement in your account, $24,199, whereas you get down to little old sugar, which can be traded on a $550 margin per contract. And so we do this equalized margins where essentially we bring everything up to the margin level of the DAX. And once again, little old sugar continues. It's just been like this since the start of the year. It's just incredible, and it continues to be an outstanding performer. The Russell continues to be going really, really well. So, as John's alluded to in past webinars, and perhaps that's something that that John, I know in the previous webinar, John selected out of these futures a couple of subsets that people could trade on smaller accounts. And really what this is demonstrating is that those subsets that John talked to in the last webinar on these smaller accounts are continuing to perform very, very strongly. Okay, John, I think from me, those are really the key points I wanted to cover, unless you can think of anything that you and I have discussed over the last few days that I've missed.
No, thank you, Daryl. I think that's absolutely outstanding presentation. And for our guest today, I've been, talking to Daryl and Sage as they've worked through this process, and the amount of work. It's just been, weeks and weeks of endless work all day, every day to do all this stuff manually. So we're most grateful to you, Daryl and Sage, for doing this. What I haven't told the folks yet is that we now, Daryl, I'll say thank you, but I'll mute you because there's a bit of background noise there. I want to thank Daryl and Sage, who've just done a huge amount of work on this. It's been all day, every day. Fortunately for us and unfortunately for them, the weather in Wellington, New Zealand's been very inclement, and it's been raining 9 of the last 11 days, so they've been locked inside working on this stuff for us, and I thank you. Let me see if I can get this back to see if I can get back let me see where we are. Daryl, I'm trying to get myself back to being a presenter. And that should now be working, I think. Yes, okay. Yes, so thank you, Daryl. That's been terrific. I've just got a note here from Terry that the auto trade, Terry's saying he went added up today's gains and losses. The auto trade is plus $14,079 today. This is on all the trades that closed today, so April's looking pretty huge. All right, folks, I think Daryl's shown you the various summaries. Let me just bring those over here so you can see them again. That should move over fairly shortly. There's a bit of a delay on the data coming through here. This is Forex, and as Daryl said, he hasn't included April year to date, so you can add these figures depending which stop you're using. The text stop, you can add $6,800 to these year to date figures. Why is that not muted? Should be now. Sorry, that's just some background noise coming through from Daryl's microphone. I thought I had muted him. So that's that one. Then you've also seen the futures summary here, and here's the we should see it now. Here's the January, February, March 2014 figures, and I've added in for you here the April figures to the 15th of April, so we're up at 84,200 odd on futures. So you're pretty famous. I think this is an incredible program. We continue to work to develop it. Those of you who've asked questions, Mark and Greg and guys, don't go away, because I can see that we've got some questions here, and I always answer questions at the end of the webinar, so I'll be coming back to you guys when we finish the rest of this presentation. So that's that. It's all pretty exciting. The big news is we've actually now got our FractZen auto trade running. And I know with a lot of you who had trials of FractZen, you came back and said, you know, look, just love all this but can't handle it, too many trades and all hours of the day and night, and I can't stay awake 24 hours a day. It's always been our intention to develop an auto trade for FractZen, and we now have it running thanks to Terry, who's written the program for us, and some support from Trade Navigator. It's been very, very difficult because no one's ever done this before, to our knowledge, or Trade Navigator's knowledge, who are our charting people that we work with, and we've had to write considerable amounts of new code to get this running. But we've had the auto trade running now for 8 trading days. We've had 1 or 2 little glitches concerning contract rollover dates. We have a manual fix. We know how to deal with that now in the auto trade, and Trade Navigator are working on an auto fix that will hopefully work more effectively than it has been. Next week we're going to run the auto trade and test it against the manual results that Daryl and Sage are recording, and if that all balances up, we're going to release this auto trade so that you can forget about having to be up all night, and you can have the benefits of this marvelous program. I'm not exactly sure quite how we're going to do that. One of the options that's probably the easiest option to begin with is what's called a leader-follower program, and that is where we will have an account, and you can sign up to that with Jerry Winter, our broker who runs most of this stuff for us, and what will happen is that your account will work exactly the same as what's in our account. So whatever fills we get, you'll get, and you won't have to watch the account day to day. You won't have to watch the signals. It'll just be automatic. That's called a leader-follower system. That's the easiest form for us to implement, and we'll be working to put that in place possibly as soon as the next 10 days to 2 weeks. The next step after that is to come up with a version that we can release to each of you individually. That's a little more complex because we have to find some way of controlling the number of contracts that you're trading, and see if we can discourage you from fiddling with it too much to allow the program to run, and that's going to require some more coding. That might be some time away whenever we have to work in conjunction with Trade Navigator on any of this coding. We take a place in the queue for jobs that need to be done. They do give us a degree of priority, but we do wait for this stuff to come out. Anyway, we do have the auto trade working, and it should be in a position to be released in about the next 10 or 12 days, hopefully. So once again, Daryl and Sage, thank you. Let us move on, now that you've seen these results, to the middle of April, and let's have a look at some charts. I wanted to talk to you today about 2 things. I'm just waiting for your charts to change, which they've done now. And I wanted to talk to you a bit about the US equities market. We've been getting an awful lot of talk lately about, markets are topping and the end of the world is here. But, in truth, folks, we've been getting that since the March 2009 low. I don't know how many times I've read that this market is in a secular bear market and this is simply a rally. Well, all I can say about that is 666 up to, 1800 odd, some rally. So don't believe the people who write a lot of this stuff, because much of it's written to be controversial, and people were truly honest and just said, as I do, the trend is up, it'll stay up until it's not. That's not so exciting, and you probably wouldn't be rushing to read it. So they do tend to write controversial stuff, and there are also people who are just habitual bears, which is the wrong way to be. You should never have neither be a bull nor a bear, but take advantage of the Danielcode to trade both ways. So this chart I'm showing you now is our 6-day chart, our timing chart, which you've seen dozens and dozens of times. And the blue lines on it, excuse me, are the Danielcode trading channel, which has a very specific set of rules for those of you who are new to us. And if you'd like to learn how to draw these trading channels and what they mean, there's a extensive webinar on it. If you just click on the video tab at the Danielcode website, you'll see a whole heap of videos there that are webinars that I've done in the past, and one of them is called Trading the Danielcode Trading Channels, and in that, and it will show you exactly how to create these channels and what they mean. You can see here that, let me find my little spotlight tool here. You can see here that all the way from the March 2009 low, this market has run incredibly precisely. This is a 6-day chart. This is our basic Danielcode timing chart. Each bar represents 6 trading days, and there are reasons for that. You can read about that. Click on the articles tab at the website, and you can read about how market timing works. There's 2 articles in particular there. One's called a Masterclass, it's about time, and the other one's called Masterclass Timing Gold. You can read exactly how we do this stuff, but look at the exactitude with which this market has run inside the Danielcode trading channels. It hits a high, it retraces. That was the low. Remember, this trading channel adjusts as it moves on. Hitting the high, this is the first lines above and below. The darker line in the middle, that's the median. And the first line above is 1 standard deviation. The first line below is 1 standard deviation. And in Danielcode parlance, 1 standard deviation for this market is 1.593. And then it went down and hit the 2 standard deviation. And our normal assumption from that is that on Newton's law of each action has an equal and opposite reaction, we would at some stage expect this market to hit the 2 standard deviation line at the top, which is way up here. But what's happened in recent times, and when I spoke to you last, just looking at this area here, the recent trading, I said to you that this market had 1, 2, 3, 4, 5, 6 closes above 1 standard deviation from the mean, and markets find it very hard to do that, and I told you that there would be a correction from that. Well, there has been a correction. It's been a very shallow correction, but the point I wanted to show you is that I've now drawn a new Danielcode trading channel that starts from back here in September 2011. Look at the time period this chart covers. And this market is now running inside a sub-channel, which is the black sub-channel you see here, and it's been running up here with a degree of perfection. Right in this spot here, let me find a different cursor so I can, right in here you can see this December 2013. We're closing above the main channel, the dominant channel, that's the blue channel, but right at the top of the black channel, and then our correction took us right down to the bottom very precisely, back up again through the median, and tried to test the upper 1 standard deviation, was unable to do so, so it's corrected, which it needed to do. This market is very overbought, and what it really needs is a decent correction. And if it has one, don't panic. It won't change the trend without a lot more work. But interesting thing here is that these 2 Danielcode trading channels intersect way up here, which fulfills a couple of things. First of all, it gives us a touch of the 2 standard deviation blue line, which we have been expecting, since it touched the bottom 2 standard deviation line way back in September 2011. And that gives us a price of around 2100 at the end of this year, late November, mid-December. There's nothing to say that's the high and the end of the world, but that's our target. And as long as this market stays within its trading channel, that will be achieved. So that's our present update for you. We think this, I think this market is going to go to 2100 by the end of the year, and the trend is still up. And for that, me to change my opinion about that, when the chart changes, I'll change my opinion. And the first thing to be looking for would be for a close on the 6-day chart below this line, this black dotted line here, which is down at about 1800 at the moment. So that's where this market, I think, is going to go. That's the present working assumption. We've been, those of you who've been with us long enough will remember that I called this March 2000 low to 2 ticks and the day, and I've been long-term bullish about this market ever since now. Excuse me. Because we're futures traders, being long-term bullish is interesting. It's a background, but it doesn't mean that we're always buying the market. We trade both ways because we're futures traders. Short trades pay exactly the same as long trades, and we're actively involved in trading this market both ways. Which brings me to want to talk to you about this next chart, which I'm about to show you. Your charts have now changed. This is the S&P. This is the E-mini futures contract. And I wanted to talk to you about this rundown from April 04 and this sort of period of trading that we've had recently. So if you look at these indicators on the bottom, they're very simple. There's a Danielcode fast stochastic, which is a 533 stochastic, and a Danielcode slow stochastic, which is a 1433 stochastic. They're slightly different to normal stochastics because they ignore inside bars, which is one of the major causes of errors in stochastics. But at that high here, you can see running into this high, we're actually, this was the week that we took off. But you can see that on the Tuesday, that would be April the 1st, we had perfect target recognition of the Danielcode blue line, and then it waffled for a few days, but that set up a bit of an alert for the reversal signal coming. And as we moved up into Thursday, you can see that we had the fast stochastic overbought, the slow stochastic overbought, and we had big divergence on our proprietary momentum indicator. And that means that the market made a new high, but the momentum indicator did not. And that set up a standard blue line sell signal to get short on April the 4th, and it went down on the 4th, down on the Monday, which was the 7th, and then you see what happened on the Tuesday the 8th. It found another Danielcode blue line, and it reversed at that blue line, which set up the TO3 buy signal for the next day, which was here, and up it went. Big trade, very good, very profitable. Now, this is where the problem comes. Do you hold on to these reversals, or do you just take the first profitable close, say thank you very much, and get out? The TO3 signals, the suggested way to trade them is you exit at the first profitable close. So if you were trading that way, you got out the close, and then the next day was a sell. It was a bit hard for you to see. I was traveling, and I put up those signals I could, one of which was a sell in the DAX. And you'll remember that through your correlations, which I've talked to you about many times, a signal in any one of Dow, NASDAQ, Russell, S&P, and DAX, they are so highly correlated that they can be traded in any one of the other equities if they are elected. So this sell here came in just under Wednesday's bar, and down it went 2 days. Now, if you'd held on to that winning trade, you lost all that money, and you got it back down here. But this is the question of, do you hold it on a TO3 or not? Well, I can tell you the blue line trades are the most reliable to hold a signal on. They don't always set up, but here's one way back at March the 7th, and you've got 1, 2, 3, 4, 5 days down there was worth holding. The next blue line signal actually comes here, where you've got both your stochastics overbought and divergence on your momentum. You get these on the website if you subscribe to the plus signals. I put these up for you because you don't see all of the charts, because I don't do the Danielcode targets on all of the charts, but I have them and I put up these signals for you. So there was a standard blue line sell. We went down 2 days, 1 day up, and this was a TO3 signal. And if you followed the suggested protocol, you exit there at the close. Then, excuse me, if you were subscribing to plus signals, you got short again. You got 2 days down, and right down here on the 14th of April, we had another blue line buy signal, and that signal has returned $1,975 up into today, where we had a sell and we got stopped out of the long side. But this is the question of, do you hold these one-day counter trends or not? Well, the signals are the same. We don't actually know whether it's going to be a one-day counter trend or a two-day counter trend, but our assumption always is that the trend will reestablish itself after a 1 to 3 day counter trend. Now, the most common form of a counter trend in a fast-moving market is 1. So whenever you get 1 bar up, you'll often see that I'll have a signal buy 1 day, it gets selected, I've got a sell up there under the plus signals the next day, and that's because our default assumption is that that 1 bar up is simply a 1 day counter trend, and if the low of that bar is taken out, the trend will continue, which is what happened down here. So how do you deal with this? Well, the simple way, you can either exit first profitable close on everything, or if you want to hold signals, be more aware of the blue line signals. They're the ones that have the higher probability of giving you at least an interim change in trend. And that was really what I wanted to talk to you about today, folks. So thank you for that, and thank you for your attendance. I'm going to end the webinar now, but don't go away, please. I'm just going to switch off the recording and end the recording part of this. And then I'm